You say we need to get closer to the end of the rate hike cycle. We need to get closer to inflation getting kept in check before we can buy. So you do see much more pain coming up, or I should say more pain coming up in 2023. And I want to ask you how much. Yesterday, Matt Maley said maybe 3,500 on the S&P, maybe even lower if we want to get down to valuations around 15.
Sure. So, I don't know how much lower we'll go. That being said, I think it's, now clear to us anyways that between 3,500 and 3,700 on the S&P that there's good value for intermediate to long-term investors. We've done a lot of work with respect to the bear market, both in price and time. And so in that first half is when we'll be looking for kind of opportunities to go shopping, right? We've got kind of our lists made. Will it be the bottom? Only time will tell. But again, now that we're almost a year into this bear market, it's low. I think we were almost off 30%. We've seen enough to kind of let us know that, okay, we want to kind of be, kind of on guard for, additional opportunities in that new year. So I think, again, 3,500 to 3,700 is the area we'll be watching for. With respect to, will there be additional pain? We think so. And I think, if anything, this most recent news out of China with the reopening being as quickly as it's happening probably complicates the Fed's, job with respect to putting a little bit of a bid under oil prices, putting a little bit of a bid under, inflation globally, through aggregate demand. So I think that's going to be one of the biggest things that we'll be watching in the first half.
If the Fed goes 50 basis points in February, that brings us to 5, and that's pretty close to what most people expect the terminal rate to be. Samir, is your window to get in then shorter if the Fed goes from, last hike to first cut pretty quickly?
Yeah, that's exactly why kind of our pencils are sharpened, and first half of next year is really the time that we're looking for with respect to trying to add risk. The first step was to add some duration. The next one will probably be to take on some credit and some equity risk. So yeah, that's exactly our plan. And, again, probably don't want to get too cute here because, history tells you that, maybe we need to trade at something in the low threes. Well, look, if you're buying at 3,500, you're within 10% of that, and the upside probably is 20% plus.